Now, Nigeria's Monetary Policy Committee has held the country's baseline interest rate at 14% for the last 8 straight sessions. However, as concerns about inflation wane, analysts expect the country's monetary policy to turn expansionary. My panel of experts today on the show: Eme Essien Lore, IFC Country Director Nigeria; Bismarck Rewane, CEO of Financial Derivatives; and Taiwo Oyedele, Partner and Head of Tax Regulatory Services at PWC Nigeria, join us to discuss monetary policy, tax, and Nigeria's development objectives in 2018. Thank you so much. It's a pleasure to have you, gentlemen. Eme, for joining us today. So we're starting our discussion with Nigeria's monetary policy. Bismarck, I think it would be good to start with you. Now, we've seen, of course, headline monetary rate at 14%. CBN has watched very closely inflation, which we saw, come down gradually in 2017. But first, I want to start with the issue of, having a quorum, because we're expecting to have the first meeting for the year this month. What's going on with that?
First and foremost, the central bank has not put on its website that there will be a meeting on the 22nd and 23rd, which is the usual period. All we know is that inflation rates are coming out tomorrow morning at 10 o'clock, and that they're looking for 8 members. 8 members, 2 deputy governors are left, and the 4 members. And so in all, they don't have a quorum. All right, and so the question is, what do you do? The National Assembly is resuming from recess on the 16th, which is tomorrow, right? And therefore, and they have a full agenda. What will make the MPC, considering the MPC members, a priority is an issue. There are people who have been on the pipeline waiting for confirmation from the National Assembly since July last year, PENCON and others. So the National Assembly, first and foremost, have to be motivated. I mean, in terms of they have to know exactly why they are doing that. And so that liaison between the National Assembly, the legislature, and the executive has to ensure that they understand they are aligned in terms of having a priority, number one. Number two, at this point in time when we are exiting the recession and trying to accelerate our growth, the importance of the Monetary Policy Committee cannot be overstated. It is extremely important that we have these confirmations done immediately. So I think that good sense will prevail over emotions, and that it will be fast-tracked. But the interesting thing is that it doesn't have to go to the plenary. These are not, it's only the governor that goes to the entire House. So the committee can meet very quickly. If the committee could be called back from recess to deal with what they call it, fuel scarcity, that's very important. A committee can also be called in to sit and review the membership. I think it's important.
I guess we can only keep our fingers crossed that will be sorted out. Eme, what are your expectations, monetary policy 2018, if we can get past this, them forming a quorum and actually holding a meeting?
We don't expect much change. Obviously, the central bank wants to focus on fighting inflation. And so I think that will continue to persist during the course of the year. Frankly, the concern that we have is really the interest rate environment, which makes it very difficult for companies to borrow. So this is fundamentally the structural problem that we have in the economy. So I think if we, going forward, we can expect not much change in terms of monetary policy, continuing to fight inflation. And so hopefully through the end of the year, and this is from the investor perspective very important, focusing on exchange rate stability. That's the key objective.
Now, Taiwo, this year, obviously, on the fiscal side, government will be watching its revenues. We know that there's a strong push, especially through the Voluntary Assets and Income Declaration Scheme, VADES, that ends in March this year. So, but then things have been looking good from the revenue point. Oil prices still around $68, $69, $70 per barrel. So that's more money coming into the coffers. So, but then that tax drive, do you think that still looking at tax to GDP ratio is still low. So do you see that changing in 2018?
Yeah, I think good news is that the price of oil is going up. Again, I'm not very excited because that's not because of anything we've done differently. The not so good news is that because of the price of oil going up, we're having to pay more in subsidy. And that puts a drain on government, even though we found very smart ways of giving it a different name. Either we call it under recovery, and there are even guys who are asking, can we get a tax incentive so we can continue to sell at 145? So the truth of the matter is, whether you ask the CBN to sell at a reduced rate of dollar, whether it's with the NNPC or with the FRS, it's still subsidy. That doesn't help. The other not so good news is that the tax to GDP ratio, as at the end of 2017, is actually now down. It's no longer
Lower
up
than
to
the
6%. So it used to be 6%, but now it's around 5% because GDP in nominal terms has grown faster than the small growth we had and recorded in the tax aspect. Even though Custom, for example, said they made 1 trillion, we were meant to clap because we've never made that before, but compared to what was possible, that's a drop in the ocean.
Bismarck, I know that you wanted to add to that?
Yeah, I wanted to add to the fact that, yes, while I agree with what you're saying, I think that the increase in price, when you multiply that increase in price by the amount of exports we have, it far, outperforms the cost, incremental cost, because all that we are importing or processing for local refine is maybe 400,000 barrels a day max, right? And what we are exporting is about 1 point, so the increase in revenue is much more than the increase in cost as a result of for refining purposes. So net, from a fiscal perspective, we are better off. However, how sustainable is it? Number two is that, like the point she made was that we are in an interest rate environment that is, we expect a decline in interest rate environment, but we are worried about inflation. The reality is that if you actually project for a maximum of maybe a 2% drop in the policy rate, 200 basis points, that will translate into the transmission effect of that on inflation could be as much as almost 1 or 2% increase in inflation, but also on the exchange rate could mean that it could be maximum about a 5 to 10% depreciation in the currency rate. But because of that, the growth multiplier effect will far outweigh, these negatives or these challenges. So if you take a look at Ghana reduced interest rates 4 times in 2017.
Okay.
And inflation came down by as much as 7%, and growth went from 1% to 9.3%. I'm not saying the same thing will happen because they're different economies, but definitely the cumulative decline in inflation for the whole year in 2017 was 2.8%. And that's not enough. You now need to allow, if you are waiting for that to happen before you can actually bring down interest rates, you're going to wait for a long time. This economy needs to be stimulated, and we have to accept the fact that you can't make omelette without breaking eggs. So there'll be some inflation, there'll be some pressure on the exchange rate, but no better time to do it than now that you're having high oil prices. And high oil revenue.
Exchange rates, we saw the CBN struggle last year, but it paid off. We saw some level of sanity and a bit of a convergence across, the different markets. For 2018, are you expecting that to continue? Do you think at some point we will be able to say, okay, this is the true value of the Naira?
So it's a good question, because at the end of the day, we're in an environment where, as you said, oil prices are up, right? So when we look at our projections for 2018, we're looking at sort of mid-50s as sort of the benchmark, right? But now we're seeing oil prices even higher than that. This is all linked to oil prices. So the question would be, if oil prices do drop, and that's now an exogenous force, has nothing to do with the country, what would happen? And so it's very much tied to that. So we expect oil prices to remain in this level, if not a little bit higher, through the course of the year. And as a result of that, we expect to see exchange rate stability. So that's a positive thing. But the reality is that structurally not much has changed. Structurally, we haven't seen much change. We have certainly seen a lot of movement in terms of tax policy and tax administration, but it hasn't been enough given what the constraints in the economy has been. But this is important because investors do look for that kind of exchange rate stability. And that's what we need to signal to investors, that there is that stability going forward. And as a result of that, they'll be more willing to bring in long-term capital. We've seen a lot of portfolio flows come into Nigeria. That's been great. But we need foreign direct investment to really stabilize the economy.
Taiwo, last year was, like Eme said, we had a lot of policy drive. And that, we saw that going into different sectors. And it would appear that was what we focused a lot on, last year. We had the economic recovery and growth plan. Would you say that now, 2018, we should begin to see or reap the benefits, as it were, from those policies? Or do you think that if oil prices are sustained for a long time, we might begin to lose sight of the fact that we're still a mono economy?
Yeah. So I think I always like to start with this. conversation around oil, we need to realize that we are not an oil-rich economy. Even if you go back to $100 per barrel, and the total gross receipts at that amount will be less than $100 billion, it can't solve our problems. So whatever it is, we must keep focusing on tax. But again, the conversation sometimes is on, we want to gain more revenue. Can we collect more? That's a wrong priority. It should be looking at tax as a tool for economic management and development. It could be that you will use that to try and provide incentive, not the kind that everybody's asking for, the ones that are targeted. But what I would say essentially is that the policies we saw in 2017, from the national tax policy itself, which was a very commendable effort by the federal government, to things like the voluntary asset and income declaration scheme, they're all good, but they're disjointed. So what I would suggest for 2018 is we need to consolidate and see what is working, improve on it. Whatever is not working, we need to review and think about what else do we do, given the circumstances that we find ourselves now. Unemployment worries me, for example. And the more people that lose their jobs, the less personal income tax we collect at state level. And that's actually the level where we have more financial strains than at the center. And that needs to be considered carefully.
Bismarck, I'd like you to start.
From a macroeconomic perspective, typically what happens when you are in a recession is that you actually lower interest rates and lower tax rate as an incentive for people to invest. I think the tax rate itself can be lowered, but the effective mobilization and collection process will be improved. I think that's what we're talking about. But definitely as a tool of management, what we should be seeing is lowering of rates, improvement in the compliance rate, right, and increase in the revenue, so that serves as a incentive so that people can invest more, and some improved capital allowances, and all the incentives that come with pioneer status. All of those things can be looked at comprehensively together with rates. I think that the tax to GDP ratio is low, and that's unfortunate. But is it because of the tax rates, or is it because of the collection mechanism? And thirdly, and most important, is that we are shifting more now towards a benefit approach, tax approach, which is the VATs, the consumption taxes and all that. Those taxes are quite regressive in the fact that the poor man pays the same rate of tax as a rich man. So when you take the canons of taxation, you find that they should be progressive, they should be equitable, they should be efficient, they should be neutral. Now, some of those taxes, some of those increased new excise duties and all that are not neutral.
Okay.
Right? They can become inflationary and distort the allocation of resources. So we've got to look at tax both from a public finance perspective, as we're looking at, the ratios will tell you that, but more important, as where are we in the business cycle? If we're in a recession, we want to get out of it fast, then we have to do what the US is doing now, these big tax cuts. Okay,
we have to move now. Let's focus on Nigeria's development objectives, Eme. I mean, it's been over 2 years since Nigeria committed to meeting the 17 Sustainable Development Goals. I mean, we've had some similar before this, but where would you say we are right now in terms of how we've been able to successfully implement some of these goals?
Well, I think, we saw the follow-on publishing of the EGRP, the Economic Growth and Recovery Plan, which was an important signaling, I think, to investors that Nigeria is going to take the development agenda and make sure that it's backstopped by an economic agenda. So there's been some progress, but certainly a lot more needs to be made. From our perspective, when we look at the different pillars of the economy, there are two that really are critical to, again, if you could turn the tide on two particular sectors, I think that would really turn the direction of the economy. That would be agriculture and power. With agriculture, I think in 2017, we saw a lot of government support. I've spoken to a lot of investors who've been very pleased with the support that they've gotten. The question I have around that support is, when does it become sustainable? Because we're still in an environment of quite a bit of subsidy for the sector. So there's a lot to be done in terms of improving productivity so that companies can start to invest in the sector profitably. And as we know, agriculture employs about a quarter of Nigerians. It's about a quarter of GDP. It's a phenomenal part of the economy. There's a lot more to be done. On the power side, there's a power sector recovery plan that's been issued. We think that 2018 is an opportunity for government to signal that they're very serious about this. It's going to be a bit about cracking eggs in order to make an omelet. There are going to be difficult decisions that have to be made. And what we'd like to see is that to be depoliticized. That's very important for investors, that, you know, as a result of a political cycle, they're not making certain decisions. So we recognize it's challenging, but at the same time, in order to really make progress on this, this is what we're going to have to see in 2018.
Okay, well, still with me in the studio are Eme Essien Lore, IFC Country Manager, Nigeria, Bismarck Rewane, CEO of Financial Derivatives, and Taiwo Oyedele, Partner and Head of Tax Regulatory Services at PWC Nigeria. Thank you so much for sticking with us so far. We've talked about Nigeria's growth objectives, we've talked about tax, but I wanted to focus more now about tax. Taiwo, let me start with you. We've talked about Nigeria's tax to GDP ratio still low. VAT ends next month. How much progress have we had with VAT?
Not much progress, even though VAT itself is a very good and brilliant idea, because not only would that help you make some money in the immediate term, it would also help you to expand the tax base, which is the most important thing. Unfortunately, I think there's the trust deficit in the system. People are wondering, why should they have to pay tax when they're not sure how government is going to spend the money or whether the money will be stolen. And even the money that hasn't been stolen, in terms of priority, it's questionable. But I think also fundamentally, we're not seeing leadership by example. Let me just put it that way. It would be nice to see even those in power to say, well, I have done it, because we all know that many of them, majority of them, are not compliant. And I'm hoping that in a pre-election year 2018, we'll begin to think about those kind of questions. If you think about how compliant someone has been, say in the past 3 years, not just that they have a document that says tax clearance certificate, what you're going to find is you screen out a lot of touts, because it takes someone of a higher moral standing and ethical standard to pay taxes as at when due. And that in itself, I think, will help with governance.
Okay.
So for VAT to work, government has to take the leadership. They have to try and get people to buy in by demonstrating to them that the money will be used for their purpose, and then maybe we'll begin to see some significant gains.
Okay, let's dive a little bit. I'm particular about infrastructure. Bismarck 2018, we have a 2018 budget, and of course we're still focusing on infrastructure. We need foreign direct investment, obviously, but from the portfolio side, we have a lot of that coming into the capital market. But in terms of actual investments going into infrastructure this year, are you optimistic?
Well, let me correct one. You see, we have about $15.63 to $17 billion that has come in through the IE window, portfolio money. And this is a year which we expect the United States to increase their interest rates 3 times. This is a year in which we are expecting to lower our own interest rates. So the interest rate inflation differential is going to be negative. So one can easily forecast that there is going to be a reversal of capital flows sometime this year. Luckily, because of the high oil price, some of those flows that are reversing will be covered by the increase in oil revenue. But it's going to be a challenging year. 1 year to an election is not a year in which investors are going to be coming in. If anything, there's the uncertainties and the complexities will increase. At best, we maintain the same level. At worst, let's project for some reduction.
We have just 2 minutes left. Eme, picking up from what Bismarck said, we're not going to, well, he says we're not going to have investors coming in a year like that. I mean, for a country like IFC, I mean, you've had investments. Is that your thinking too? Is that your sentiment
Absolutely. We expect this to be a slow year, just in terms, I mean, Nigeria has been very good at coming up with development agendas. We have a lot of very good development agendas. It's always in the execution and the implementation. And a pre-election year is probably the most challenging time to really start to implement. So a lot of the things that we would have liked to have seen from a policy perspective, we just don't expect to happen this year. And as a result of that, there's still a number of sectors that are very interesting for investors. It's just that in terms of the quantum of investment, this country needs a lot of investments. It's sizable amounts. I think that's going to be challenging. On the infrastructure side, it's going to be extremely challenging. I do appreciate the government is really trying to be innovative and creative, coming up with different ways to attract private sector investment. But ultimately, there's a recognition that pre-election year, are there going to be policy reversals? Are these things that the next government is going to want to maintain? And also, what is the appetite for government to really move forward on some very difficult, challenging policy things? This year is going to be very challenging. Okay.
Taiwo, 1 minute. Then what should the government then do? I mean, focus on tax if we're not going to get all those, have all those investments coming in?
I think government needs to try and have some alignment. between monetary, fiscal, trade and investment policy,
Okay.
and as well to get some coordination amongst even government at the center, legislative, executive, government agencies, and also sub-national level, because at the end of the day, it's about the whole entity called Nigeria.
All right, thank you so much, gentlemen and ladies. It's been an absolute pleasure having you on as panelists today. That's where we'll leave it from. Of course, I've been speaking to Eme Essien Lore, IFC Country Manager, Nigeria, Bismarck Rewane, CEO of Financial Derivatives, and Taiwo Oyedele, Partner and Head of Tax Regulatory Services at PWC Nigeria.